Good morning, everyone, or good evening, depending on where you are joining from. It's a privilege to be with you today as we explore the commitments, the opportunities, and the responsibilities that come when we step into the future. My name is Cathie Wood, and I want to invite you to lean in, to imagine what is possible, and to prepare for what is inevitable. Because the future doesn't come to us slowly, it arrives at speed. The world is shifting beneath our feet. What once seemed stable, predictable, and permanent is now proving to be remarkably fragile. For decades, we've built systems, financial, political, and psychological, around a single axis of trust. But the reality is, when everything is priced in one language, risk is silently accumulating. And that risk, like gravity, never disappears, it only transfers from the visible to the hidden, from the short term to the long term, until it demands attention. We can no longer afford to think in one dimension. The era of relying on a single currency as a store of value, a unit of account, and a medium of exchange for the world is drawing to a close. This isn't pessimism, it's recognition of change. The patterns are already visible in capital flows, in technology adoption, in the diversification of reserves. The trust we once placed in central systems is being redistributed into networks, algorithms, and alternative assets that operate beyond traditional borders. The global economy is now digital, decentralized, and dynamic. Value is no longer confined by the old guardrails of geography or government. Money is evolving into code. Ownership is evolving into networks, and opportunity is expanding to those who are willing to rethink what value truly means. History reminds us that every financial era ends when innovation challenges convention. Gold gave way to paper. Paper gave way to credit. Credit is now giving way to cryptographic trust. But this transition is not about abandoning one form for another. It's about recognizing that resilience lies in optionality. Relying on a single currency is like navigating the ocean with one sail. The moment the wind changes, you lose direction. Those who understand this dynamic are already adjusting their portfolios, diversifying across digital assets, commodities, innovation-driven equities, and other stores of value that are not dependent on one monetary regime. The coming decade will test our assumptions about money, inflation, and the concept of safety itself. Traditional safe havens may no longer provide true security if their underlying systems are over-leveraged or politically constrained. The definition of safety is evolving, not toward what is familiar, but toward what is adaptive. In a world where algorithms trade faster than central banks react, information, not authority, is power, and those who embrace technological transparency over institutional opacity will be the ones who thrive. It's easy to be nostalgic for stability. It's comforting to believe that one system, one currency, one policy can preserve order. But innovation rarely asks for permission. When the printing press was invented, it disrupted power structures. When the internet emerged, it redefined information. And now, digital money and decentralized finance are rewriting the very foundations of exchange. Each wave of innovation creates volatility, but also immense opportunity. Those who fear the disruption miss the creation. We are entering a phase where diversification is not simply a financial strategy, it's a survival mechanism. The world's wealth will increasingly be distributed across systems that are global, open, and verifiable. The winners will be those who understand how to bridge the old and the new, to operate with conviction amid uncertainty, and to see innovation not as risk, but as resilience. Every major shift in human history began with a crisis of confidence in the old order. What follows is reinvention. What follows is creativity. What follows is freedom. The same will be true of this monetary evolution. The trust that once resided in centralized balance sheets will now flow into code, transparency, and collaboration. So as we move forward, don't rely on one narrative. Don't rely on one system. Don't rely on one currency. Think globally. Think digitally. Think exponentially. Because the world is not collapsing, it's recalibrating. The new monetary landscape will not be defined by a single issuer, but by billions of participants who transact, invest, and innovate across networks that are borderless and self-sustaining. In the end, what protects value is not the name on the currency, but the trust in the system that supports it. Trust built on transparency, adaptability, and innovation will always outperform trust built on control. The future of money will belong to those who understand that real strength lies not in uniformity, but in diversity, and those who position themselves today, not in reaction, but in anticipation, will be the ones shaping the next era of global value. In times of uncertainty, clarity often comes from simplicity. We are surrounded by abstractions, digital balances, algorithmic trades, derivatives of derivatives, layers upon layers of representation that have slowly detached from what is real. But every cycle reminds us that when the music stops, value flows back to what cannot be faked, replicated, or inflated away. That's the essence of owning real things. Real assets tell the truth. They cannot be printed at will. They cannot vanish in a line of code. They are the foundation upon which trust is built, the anchor that keeps us grounded when speculation soars too high. In a world where monetary policy can change overnight, where central banks expand balance sheets and governments rewrite fiscal rules, tangible ownership is the quiet rebellion against uncertainty. Owning real things isn't just about commodities, land, or infrastructure. It's about having exposure to productive assets that create and store value through real-world activity. Whether it's clean energy systems powering cities, data centers running AI models, or materials enabling the next generation of batteries, tangible innovation is where true resilience lies. It's easy to get swept away by financial engineering, by charts and momentum, but the future belongs to those who own the underlying engines of growth. Throughout history, every period of monetary excess eventually rediscovered the importance of the real. The tulip mania ended when bulbs met the soil. The dot-com bubble burst when companies without products ran out of cash. Even today, as the digital economy expands, the infrastructure enabling it, energy, hardware, transportation, remains essential. The code may be infinite, but the electricity that runs it is not. We are witnessing a global transition, away from paper promises toward productive reality. Real things have scarcity, they have use, they have consequence. They produce, they sustain, they endure. And as inflationary pressures test the credibility of policymakers, as currencies fluctuate, as financial assets detach from fundamentals, the shift toward owning real things becomes not just a choice but a necessity. Yet the idea of real has evolved. It's no longer limited to physical commodities or property. It includes intellectual capital, innovation platforms, patents, and technologies that directly reshape human productivity. These are the new tangible assets of the digital age. The factory floor has become the server farm. The oil field has become the data pipeline. The mine is now the mind. The key is to identify what generates real utility, real adoption, and real economic impact. When markets wobble, narratives change. Speculators chase what's moving, but investors with conviction look deeper, to the assets that will matter 10 years from now. They ask, what will the world need more of? What will remain scarce even as capital flows surge and retreat? The answer is the same across energy, technology, infrastructure, innovation, and human creativity. These are the real things that transcend cycles. We've entered an era where the intangible and tangible are merging. Artificial intelligence is only as powerful as the chips it runs on. Electric vehicles are only as efficient as the materials that store energy. Genomic breakthroughs are only as valuable as the physical therapies they enable. Behind every digital revolution stands a tangible backbone. That's where long-term value will consolidate. Owning real things isn't about nostalgia for the physical world. It's about aligning with authenticity. It's about recognizing that growth without grounding is unsustainable. It's about anchoring belief in assets that have purpose beyond price. Markets can manipulate sentiment, but they cannot manipulate utility. Real things earn their worth every day through service, output, and innovation. And in this new age of volatility, authenticity compounds. Those who hold what the world genuinely needs will not only preserve value, they will multiply it. As monetary systems evolve, and as digital representation expands, the most powerful strategy will be to bridge the physical with the exponential, to own what builds, fuels, feeds, connects, and transforms. This is not a call to abandon technology. It's a call to invest in what makes technology possible, to focus on the foundation rather than the noise, to move beyond the illusion of liquidity and return to the fundamentals of creation. Because in every disruption, the pendulum eventually swings back to production, to innovation, to reality. So as uncertainty grows and speculation rises, ask yourself, what do you own that the world will still need, regardless of market cycles or monetary regimes? What do you own that will retain its utility, its demand, its relevance? Own that, own the truth. Own what can't be conjured with keystrokes or policy meetings. In the end, markets reward clarity, and clarity always returns to the real. Those who align with that truth will not only endure the transition, they'll define the next era of prosperity. The world rewards conviction, but it punishes concentration. Every cycle proves this truth in its own way. When the winds of innovation shift, those who have placed all their weight on a single pillar are the first to feel it break. The most resilient portfolios, the most resilient minds, are those built not on uniformity but on diversity, a diversity of ideas, assets, and perspectives. Diversification isn't fear, it's wisdom. It's not a lack of belief. It's the structure that allows conviction to survive volatility. We live in an age of extraordinary transformation. Entire industries are being rewritten by artificial intelligence, robotics, genomic sequencing, and blockchain technology. Yet, as new opportunities emerge, so do new risks, ones that can't be modeled by traditional metrics or confined within old playbooks. The very forces that drive growth also create disruption. And this is precisely why diversification is protection. It's not about spreading thin, it's about positioning wide enough to capture possibility while absorbing shocks. History makes this clear. Every major market correction has punished overconfidence. In the 1990s, investors believed the internet would only reward one or two companies. In 2008, the world believed housing prices could only rise. In recent years, investors have placed blind faith in mega-cap technology, convinced that scale alone was safety. Yet each of these narratives carried the same flaw: concentration in a single story, a single theme, a single assumption that the world would stay the same. It never does. Diversification is not about avoiding risk, it's about managing it intelligently. True diversification comes from owning exposure to different innovation curves that move independently. Energy transformation, digital finance, automation, healthcare revolution. Each may experience its own cycles of hype and correction, but together they compound. Together, they create a portfolio that breathes with the rhythm of progress, not the noise of short-term speculation. In innovation, timing is everything, but predicting timing perfectly is impossible. Some technologies accelerate faster than expected, others take longer to mature. Diversification ensures you're present when inflection points arrive, even if you can't foresee them all. It turns uncertainty from a threat into an ally. By holding multiple innovation vectors, you give yourself permission to be early and still be right. Many mistake diversification for dilution, as if owning many ideas somehow weakens conviction. But in truth, it strengthens conviction by freeing it from fragility. It gives conviction endurance. When one idea takes longer to prove itself, another steps forward to sustain momentum. When one sector faces resistance, another provides lift. The future is rarely linear, and diversification gives you the ability to stay invested through the bends in the road. Think of ecosystems. In nature, diversity sustains resilience. A single crop field is efficient until the environment changes. Then it collapses. But a diverse ecosystem adapts, it evolves, it survives. The same principle applies to capital. When you spread across multiple streams of innovation, your growth becomes organic. It's no longer dependent on one outcome or one cycle. It thrives through change. Even the most advanced models and the most sophisticated analysis can't predict every shock. Policy shifts, technological breakthroughs, geopolitical tensions, all can alter the investment landscape overnight. Diversification isn't just about numbers on a chart, it's about humility. It's the recognition that the world is too complex for absolute certainty. It's an acknowledgement that no single idea, no matter how brilliant, is immune to disruption. And yet, diversification doesn't mean drifting aimlessly. It means curating exposure intentionally to ideas that are transformative, scalable, and world-changing. It's about balancing conviction with curiosity, structure with imagination. By doing so, you protect not only your capital, but your capacity to think long term, to stay focused on innovation even when markets turn chaotic. There will always be moments when diversification feels unnecessary, when one trade dominates, one sector leads, and concentration feels like courage. But it's in those moments that diversification becomes most vital, because the most dangerous risk is the one you stop seeing. The purpose of diversification is to ensure that when the tide turns, and it always does, you remain afloat, ready to capture the next wave rather than recover from the last. The coming decade will not reward rigidity. It will reward those who can move fluidly across sectors, across technologies, across possibilities. It will reward those who treat diversification not as defense but as strategy, as a disciplined way to stay exposed to innovation while protected from its volatility. So diversify with intent. Diversify not because you doubt the future, but because you believe in its complexity. Protect your portfolio, yes, but also protect your perspective. The future will not move in a straight line, and neither should your investments. In a world defined by acceleration and disruption, diversification isn't hesitation. It's endurance. It's how conviction survives uncertainty, and how vision outlasts volatility. Every generation believes its moment is unique, that the challenges it faces are unlike anything before. But history moves in cycles, long arcs of creation, expansion, correction, and renewal. What feels like chaos in the present often makes perfect sense when viewed from a longer horizon. Thinking in long-term cycles isn't just about patience. It's about perspective. It's about understanding that innovation, markets, and societies evolve not in straight lines, but in waves. The most dangerous mistake investors make is confusing a moment for a trend. Short-term thinking magnifies noise and misses the signal. When we zoom out, we see that every disruption follows a rhythm, a period of exponential growth, a phase of excess, then consolidation and rebirth. This pattern repeats not because the world fails to learn, but because innovation always outruns regulation, imagination always outpaces comfort, and opportunity always invites overconfidence before balance returns. The long-term view allows us to embrace volatility rather than fear it. It reminds us that correction is not destruction, it's regeneration. It's the ecosystem resetting itself to prepare for the next wave of progress. Every great innovation, railroads, electricity, the internet, artificial intelligence, has endured these cycles. Early euphoria gives way to skepticism, only to be followed by sustained adoption that transforms the economy. Those who mistake the downturns for the end miss the compounding power of long-term vision. Today, we stand in one of those pivotal moments. The technologies driving this era, AI, robotics, genomics, energy storage, blockchain, are not isolated breakthroughs. They are converging. Their intersections are where exponential growth emerges. But exponential growth never unfolds in a straight trajectory. It surges, pauses, consolidates, then accelerates again. To think in long-term cycles is to accept this rhythm and build conviction that outlasts temporary disillusionment. Markets have always oscillated between extremes of fear and euphoria. Human psychology doesn't change, but the instruments through which we express it do. What separates those who create wealth from those who chase it is the ability to act counter-cyclically, to accumulate when others are retreating, to analyze when others are reacting, to believe when the world doubts. That mindset requires not just intelligence but emotional endurance, the courage to hold conviction when prices disagree. Short-term data often hides long-term truth. A single quarter can make or break a headline, but decades define outcomes. When we look at innovation through a 10-year lens instead of 10 days, we see that volatility is the price of progress. Every drawdown in transformative industries has eventually been followed by returns that justify the pain of patience. The future rewards those who understand compounding, not just of capital, but of knowledge, conviction, and belief. The economy itself moves through innovation cycles. Industrial revolutions don't happen overnight, they unfold over decades. The early adopters build the foundation, the skeptics delay adoption, and finally the mainstream accepts what once seemed impossible. Those who align themselves with these cycles early with conviction and diversification, not only capture financial upside but participate in reshaping society. Thinking long-term also means recognizing that progress is cumulative. Each breakthrough lays the groundwork for the next. The steam engine led to electricity. Electricity led to computing. Computing led to artificial intelligence. Each phase seemed revolutionary, yet each was merely preparation for the next. To think long-term is to understand that innovation doesn't reset the cycle, it extends it. Every peak and trough contributes to the next ascent. It's tempting to measure success in quarters and years, but real transformation unfolds in decades. The investors, builders, and thinkers who stay aligned with this horizon are often misunderstood in the moment and vindicated in retrospect. They appear contrarian because they're operating on a different clock. They measure not by speed, but by direction, not by reaction, but by conviction. The challenge of thinking long-term in a short-term world is discipline. It requires tuning out noise, resisting herd behavior, and anchoring decisions in research and understanding rather than sentiment. The markets will always test conviction. Cycles exist precisely to separate belief from speculation. Those who endure, who stay invested in ideas that are reshaping industries, emerge not just wealthier but wiser. The long-term view doesn't guarantee calm, it guarantees clarity. It allows us to see corrections as opportunities, volatility as validation that change is real, and innovation as a process rather than an event. The next decade will not move evenly, it will move exponentially, in fits and starts as it always has. So think in cycles, not moments. Build in decades, not days. Because progress doesn't announce itself, it compounds quietly until the world suddenly realizes how much has changed. The future belongs to those who can hold conviction long enough for it to become reality.